Good morning, everybody, and welcome. My name is Rachel Honeysett, and wow, what an absolute treat it is to be back on the Skipton Talks stage for the first episode in the Skipton Talks summer series. Please do use the chat bar on the right-hand side of your screen to ask us any questions, or even just to say a quick hello. It's always really nice to know that there is life out there on the other side of the screen. If you wave your mouse over the screen, you will see there's now options where you can pause us and you can add subtitles now too if required. So I will soon have the pleasure of introducing our first guest speaker of the series, Danny Belton, Head of Lender Relationships at L&G Mortgage Club. Danny has worked at L&G for, well, forever, 34 years to be precise, and he's been part of the L&G Mortgage Club team for 24 of those years. In his day job, Danny manages all the relationships with lenders in the club, working in partnership to deliver lending solutions that benefit lenders, brokers and indeed customers too. And more recently, Danny has become involved in the club's technology solution as well as new build and green propositions. So you may have already seen Danny in action at an event near you or on his own webinars. And what strikes me about Danny, I don't think you'll mind me saying, is his candid approach and ability to cut straight to the chase and ask those really big questions that need addressing. I'll never quite forget, Danny, the time that you threw me the first question on a panel debate, and I think it was, Rachel, are EPCs any good, or something like that, which was an absolute joy to answer, let me tell you, when I was sat virtually next to an actual energy expert. So to say I've been really looking forward to today, to be the one asking the questions, absolutely is an understatement. So thank you always, Danny, for being such a great sport. Good morning.
Good morning, and thanks for having me along. I'm really looking forward to this, and be interesting to see what hints and tips you've picked up from my style. So I don't know, you'll do it your way, and it'll be great.
Perfect. Thank you so much. I'm going to dive right in here with a report that caught my eye. This is the IMLA Q1 market tracker, and which for anyone who fancies a read on that, who hasn't seen it, it's on the IMLA website under publications. And this is a survey of mortgage intermediaries taken in Q1. I've included the average conversions here, as it's just the kind of data that I would have loved to have seen when I was a broker, and perhaps that's just because I'm a bit geeky. But for anyone who loves conversion metrics as much as me, here it is. And the good news is that caseloads are coming down. The average broker in the UK is now placing 97 cases per year. And to make things even brighter, brokers are optimistic about the market, with over 6 in 10 saying they are very confident about the outlook of their firm. So, Danny, is now a good time to be a mortgage advisor?
Well, without a doubt, Rachel, look, we've been through a really interesting 2 or 3 years, and we were in a sort of settled market that was relatively busy, sort of 2019, and then obviously we know that COVID came along and really interrupted. But what that has really done is drive more activity towards brokers. Customers are less certain of themselves in making their own decisions, really seeking that assurance and ratification of doing the right thing, needing help more than ever. And I've seen more in recent weeks actually that we know there's a lot of deals coming up or coming to the end of their term, and therefore are ripe for sort of retention and things. And with the sort of changes in economic climate and things, people are sort of assessing where they can get the best deal. So retention doesn't necessarily mean it'll be the best way forward. So they need advice and help and support to really make the right decisions that's going to hold them in good stead for the next few years as things sort of change and evolve again. So to be a mortgage advisor now, I think is a huge opportunity and something that we need to grasp with both hands, because the need of our customers, I don't think has ever been quite so great.
Yeah, I completely agree. Great time to be an advisor, but there are definitely some challenges out there too, aren't there? What do you think the biggest challenges are facing advisors at the moment?
Well, I mean, you talk about the sort of average of sort of 97 cases a year. I mean, that still sounds quite a lot to me, but I bet the level of inquiries is a lot higher than that. And I think that we have some sort of challenges on our doorstep that we can't shy away from, and that is the sort of the elephant in the room around pricing and how that is manifesting itself. So, and I know we'll probably touch on that a little bit later as we go through some of the questions that I know you've got lined up. But the reality is that, you know, it is a busy time, and it's how do we manage those workloads in the right way to make sure we are as efficient as possible. And I think thankfully a lot of the technology that's come along, you know, it's not just the legal and general tech, but there's other things out there as well that are actually enabling brokers to get to the information quicker, easier, make more informed choices in the right way. And they are definitely time-saving elements. So whilst we're becoming increasingly busy on one hand, we do actually have tools available which are making the job a little easier on the other hand, and therefore we're able to maintain a balance. So in theory, actually, could we see us be well over the sort of 100 cases per year in the not too distant future for the average broker? And I think we can, because the efficiencies are there to enable us to do that. The alternative is it actually saving enough time for us to maybe take time out and rest and recuperate and actually have some family time and where needed? So there is that balance to be had. But oh yes, it's definitely busy, definitely very, very busy indeed.
That would be really nice, wouldn't it? The vision of a bit more time, but also, like you say, driving those efficiencies so that advisors can do what they absolutely love doing best, which is spending time with customers, having those really good conversations. So all really good advancements in the market at the moment. So I'm going to kind of lead us into house prices. So something that, of course, if you work in this industry, every friend, family, person you bump into the pub always asks you, what's going on with house prices? And well, put briefly, they're on the up, aren't they? With East Midlands seeing the greatest HPI growth to March 2022 at a whopping 12.4%. So this is something that I don't think we could have predicted if we look back to sort of March 2020. So why the increase, and what are your thoughts on this, Danny?
Well, I think first of all, who would ever be an economist trying to figure this out? Because to be fair, the crystal balls are totally shot and have no idea as to what's happening, and everything catches us all by surprise every day. There's always something new. There's always something changing. But for me, the one thing that's been constant through this is consumer demand. We definitely have this issue of supply and demand being heavily out of kilter. It has been for a long, long time. And how many times have we heard that you have one property up for sale and 20 or 30 viewings and God knows how many offers off the back of that? And the asking prices are set at a level, but the actual price they end up selling for is far greater. In some instances, I'm hearing sort of 50 or 60,000 pounds above the asking price. Well, no one could ever really see that coming or envisage. But of course, it does have a knock-on effect to house prices because with supply and demand being so far out of kilter. And that's been the trend for at least the last 3 or 4 years. It's not new, probably been accentuated a bit more through COVID and today. And we're still seeing a stronger housing market. So it comes as no surprise that house prices have grown in the way that they have. What will happen going forward? Well, very, very hard to say. But you do think at some point there has to be a flattening of the purchase market. But the reality is all the data I'm seeing at the moment, the conversation I'm having, are suggesting it's still really, really buoyant. I think the cost of living will have an impact, and people will, customers will sort of review and maybe think a bit harder about what they want to do and actually what they can afford. Because it's one thing buying a house, it's another thing being able to run a house, and the affordability and the income you need to be able to do that has got to stack up. And again, that's another great reason why advice is going to be so key to every customer today. So I do think we will see a softening of house prices. I do think they may flatline. It's always possible they may dip a little bit here and there, but ultimately there will be some steady growth. I do think that we'll also see the number of offers on a property reduce. So we won't have the sort of 10 or 20 that we were getting. We may get to sort of 2 or 3 because there'll still be a number of people out there that can cope with the cost of living, still want to move, but of course we've still got this lack of supply, and maybe we'll have even less supply as the second time movers don't move on. So we're left with sort of very much sort of first time buyers and new build strength and all that sort of stuff that comes along, which will keep sort of house prices reasonably stable, if not some sort of slower growth, I think would be the best way. Yeah, that's just a personal view, but that's what I'm seeing today. Tomorrow, it could all change. We just don't know. It's just so hard to call.
You could definitely pull off being an economist there. That's just today. Yeah, it's really interesting, isn't it? Funny enough, I was having a conversation about this week, that that kind of waterlog of people tending to be staying in their properties for a little bit longer. So what impact does that have on kind of old-fashioned house price movement? I guess house movement that my parents' generation would have moved every couple of years. That was how you climbed the ladder in essence. And because of the costs involved in moving, that just doesn't really happen anymore, do you? You tend to see people staying in properties for a lot longer.
But that was the availability was there many years ago, and we've been talking as the government's been talking. Well, we need to deliver 300,000 properties a year, whatever else. Well, how long has that been going on for? And have we ever got anywhere near it? And no, we haven't. And are we likely to? Well, we'd like to think so, but we're a long way off. So we got all those challenges, and I think when you look through COVID and what we've been through, we saw the real emergence of people taking stock of their current situation and the properties they were living in. And either, they couldn't sort of face living with the family anymore and had to get out. We saw relationships sadly break down, but we saw new ones being formed. And then people who bought a house when there was two of them, and now all of a sudden they've got 3 kids and a dog and God knows what else, it just wasn't the same sort of space. And we were sort of forced to sort of get used to living under each other's feet for quite a significant period of time. And I know it sort of changed and things as we've moved on again, and having to do homeschooling and all these things has really made us think about what it is we actually want. And then we saw the exodus to the country from the cities, and now we're starting to see it go back again. And customers are really thinking about, so what do I really want? And a lot took the time to extend or improve their existing property, so they can actually stay there for a longer period of time. So I think you're absolutely right. But all of these little things have still kept the mortgage market turning over, because it's, everybody's needed to sort of, or a lot of people have needed to borrow to different levels. We've seen strength in the second charge market for smaller loans. We've seen strength in the bridging market because actually people need to do something different. They did that type of finance. We've also seen strength in the remortgage market as people wanted to, take stock of their finances, take the opportunity to increase their lending to improve their properties. So it's been a really busy time for brokers, for people needing different things. The question I have is, how are our sort of brokers skilled up enough to be able to deal with those, or are they actually sort of using their referral partners and things to make sure they can help every one of their customers? And I think that's been an interesting shift as well. And it's brought new markets, new areas to the fore that we perhaps haven't talked about quite so much in the past. And these are areas that are not going to go away, because the agenda, I know you're very passionate about a green agenda, and I'm sure we'll talk about that. But these things again are going to help us move into that sector. As we go down. But for now, people have just been focusing on, right, where do I live? Do I like it? Am I happy? Is it suitable? What do I need to change and adapt in order to sort of make sure I've got the right home for my needs for now and for the years going forward? And it's been a really interesting time to see how people have been thinking. I mean, look, you've got some fabulous wallpaper. I know we've had a chat about that before. I mean, did you put that up through lockdown and things because you needed something and it's really bright and I'll be home? I've been living in my shed. It's been fantastic. So we've all adapted to different things.
Yeah, absolutely. And it's interesting what you say, actually. We're talking a lot about opportunity, which kind of leads us cripplingly into our next subject, I guess. But you talk about opportunity, even for brokers who aren't involved in second charge or bridging finance now. There's a real opportunity in that in the years to come, isn't there, as people refinance that and remortgage that into part of their main loan. So there's lots of different pockets of the market kind of opening up now, where perhaps it was a bit more streamlined going back a couple of years ago. So talking about fantastic opportunity, I'm going to bring us down to earth with a thump now and ask you a bit about the cost of living crisis. So of course, the busiest slide in the deck, I promise they're not all like this, but we couldn't really talk about the state of the market at the moment without talking about the cost of living crisis. So as I'm ever the optimist and the last person to be scaremongering, however, I'm already hearing stories, and you alluded to it earlier, Danny, of first-time buyers getting nervous or pulling out of transactions, and upsizers perhaps pausing their plans, wondering if now is the time to make that big leap up the chain. What feedback are you getting around the cost of living crisis from the brokers within your club at the moment?
It's a really interesting one. I think there's a real mixed bag. I think that there are a number of customers who are genuinely concerned about cost of living and what it may do. And this a lot comes at a time that not only are we just generally dealing around the cost of living through cost of utilities and food and fuel and all the good things that we live our day-to-day lives by, which are all essentials. And it's really sad to hear a number of people are really struggling financially and having to make a choice between sort of heat and light or food, and do they feed the kids before they feed themselves? And that's a horrifying place to be, and I feel for anybody that is in that position. I think that we also have to sort of put alongside that the cost of mortgage rates have been sort of flying up. The swap rates have been rapidly increasing, as we know, and that's caused a number of issues. And what I'm seeing is that I'm hearing from brokers that they're trying to get to their customers earlier, because typically with a remortgage, you can probably start the process sort of 6 months out. Whereas with a product transfer, you may be able to start it 4 months out. So brokers are starting to talk to customers sort of that much earlier to actually say, look, we need to try and assess things now if we possibly can, knowing that your deal comes up in the not too distant future, because the rates today, if things carry on as what we've experienced, will be a lot more expensive if we wait until the end of the deal. So we're almost bringing forward a whole heap of transactions as a result. I think the customer view is, and certainly we're seeing it through pricing, that the 2-year has struggled quite a bit with pricing. You know, the swap rates for 2-year are probably the highest. There is more 5-year business being written. I mean, it was only 10 years ago that 5-year used to be about 30% of our market, and then it didn't take too long, you know, with certain sort of tax changes and things, that we got to sort of 50%, and I wouldn't be surprised at how much, you know, it could push on to 60-65%, you know, in current climate. You know, that's just speculation on my part. I'm not saying it's definitely going to happen, but you do see more and more people going for 5-year. But we've also seen the introduction of longer term fixed as well. You know, 10-year plus, and I know there's some even longer term deals out there as well. And you can see customers actually going, well, look, I still see that the future is uncertain. None of us generally know where it's going to go. You know, are we in a climate where interest rates are going to be climbing for the next sort of year or so and then flatten out, or not? But pricing on swap rates suggests that longer term money, suggesting the future is actually going to be okay, and customers got the opportunity to lock in for longer. Well, if you have that certainty of how much your outgoings are, you know, and let's hope we all get sort of pay rises over the coming years. And I know there's lots of news about certain sectors that are struggling with that a bit, but you know, then in theory it becomes more and more affordable as you move forward. But you have that degree of certainty as to what your income needs to look like to be able to keep the roof over your head. And you know, we know from history that customers, the first thing they'll do is keep the roof over the head. Other things will suffer first. But it is going to be a difficult time, without a doubt. But it comes back to advice. It comes back to, you know, how many of our viewers here and brokers that may watch this subsequently, you know, look at this and go, do you know, I put a customer on a 5-year rate, you know, 4 years ago. What is the rate going to be now when it comes to review? And actually, should I start to engage the customer and actually try and understand, are they in a good place? Are they thinking about their next move? Sow that seed. You know, re-engage now, because these customers are really going to need you. Yeah, you helped them get on the property ladder last time, or help them with their refinance. They're going to need it more than ever, and it's in a different environment. And I certainly don't see rates decreasing this year. I don't, you know, how far it goes into 2023 or 2024, I don't know. It's on the start. I don't think any of us really genuinely know. So we have to deal with what's now. So, you know, talk to your customers now. Find out what's on their mind. Are they actually okay? You know, are they really worried about the financial future? And maybe just that call and that conversation could actually lift a real burden off of their shoulders, knowing that actually someone's got their back financially from a mortgage perspective, so that they can worry about the day-to-day living aspect.
You know what? Well, firstly, the future is going to be okay, I think, is my favourite soundbite of the Skipton Talks series ever. So I'm going to have that made into a mug. But you know what? Really interesting what you say there, Danny, about brokers having to think a bit further forward than perhaps historically, because actually we're in such a busy time, and there's not many brokers you speak to who are kind of scratching around at the moment. Everyone's really busy. So to be able to service what you've got on your desk at the moment, but also look forward 6 months and see what's coming down the line, it's a real balancing act. And that kind of feeds into that cycle you were talking about earlier around using technology, utilising the tools that you've got available to free up that time so that you can focus on servicing those customers, and potentially a few worried customers out there with, you know, headlines and different things that they're reading in the press, you know, that could really panic them. So definitely this is underlying theme of, you know, opportunity and positivity for the market from our perspective as you know, professional advisors, which was unintended actually. So there we go. That's the unintended theme of the day, which is nice.
So before we move on, Rachel, can I just ask, because you've got another thing in there about Boris and whatever else, and I know we've talked about, we've seen the recent news around stress testing and how that's going to change. And you know, from my point of view, it's obviously positive because it will help a cohort of customers. We obviously still have to lend very sensibly from an affordability perspective, and obviously that sort of comes into the cost of living. But from you as a lender, how is that going to affect you? I mean, is this going to require sort of big system changes and things, or what do you think it may actually do to your business levels?
So good relevant topic. Well, actually, we've got a whole session on this. I won't go into it too much. We've got a whole session on this next week, which you couldn't really have timed better from a Skipton Talks perspective, could you? Because we've got Derek and Emma joining us next week to talk about affordability following the Bank of England announcement around removing the additional stress rate. I don't think anything will happen in the short term, Danny, if I'm honest. I think at the moment, definitely as a lender, it's a time to take stock. Yes, absolutely, the regulation has changed in that respect, but we also have a duty to customers against a backdrop of rising house costs and rising bills. We need to be really mindful how we move forward as an industry to that and make sure we continue to lend responsibly. But what this does give is greater flexibility to lenders when it comes to making their own credit risk decisions. We're still backed up by kind of LTI caps, etc. So it's not like this is kind of freewheeling. I've seen a real range of headlines actually, from kind of best things since sliced bread to utter madness, which I saw in strategy this week actually. And I think the truth is somewhere in the middle, and that actually we can use this as a tool to really move forward using our own lending and credit risk decisions. So I think it's a positive, but as I say, well, I won't tread too much on Derek and Emma's toes for next week. What again, without going into it too much, what are your thoughts on the changes following the Bank of England FPC announcement?
I think initially you sort of go, okay, well, this is going to be quite good news, but you then sort of put your sensible head on and go, okay, as long as we do this sensibly, we can't be in a position where we stretch people too far. And I think the rules that have been there have actually served a lot of customers incredibly well. But there are some customers that were marginalised, if you like, or just couldn't quite get the decision they wanted just because the rules were quite blunt in effect, and that's what it was. So I think to have that flexibility and to open up to a slightly larger cohort of customers, providing we maintain that degree of sensibility and really make sure that every case we write is still affordable for the customer in the right way, then I think is good news. But I say I don't think it's for me, as long as we're not lending to people that actually can't afford it or shouldn't have the level of lending that potentially they could get, then I think we'll be fine. But for some customers, it's absolutely the right thing. So a decent balance. Yeah.
We're up against the backdrop here, Danny. Repossessions are still incredibly low. I'm going to get this completely wrong, but there was something like 55-ish. I'm going to say ish because I haven't got the numbers to hand. There was something like 55-ish repossessions in the whole of the UK in January. They're tiny numbers when you consider the amount of lending we're doing. So I think against the backdrop of that, you can see why the change has been made. I think that
I think so. But I think we as a lending community and us in general, we're very accepting that people are going to have difficult times, and rather than turf them out, we want to try and help them to the best degree. So I suspect that it is good news that it's a small number, but I suspect there's been a lot of work gone on to try and help those customers as much as possible before those decisions have had to be made. And it's very sad that these things happen, but it does happen. And as long as they're at an absolute minimum, then great. Then everybody's tried to do everything in their powers to try and help those customers. Then fabulous. So let's hope it stays low, even though we know we're facing some difficult times ahead.
Definitely. I'm gonna saw through swaps because actually we're already knocking on for time. I'd like to try and finish promptly. I've got two more things to ask you about, but we touched briefly on rates a moment ago. So kind of rates. What's going on? You can't see, so just for the audience's benefit, you can't see the dates on the top of this slide here, but the swaps on that graph start from January 2018 and they're up to date as of last week because I asked our products team for them. And a swap rate, just real brief history for anyone on the line thinking, what on earth are you talking about? It's the rate at which funds are typically exchanged or swapped, hence the name. Fixed rates are typically swapped for floating rate payments based on LIBOR. I don't have long enough to go into detail on that, thank goodness. But basically, all that we really need to understand today is that swap rates tend to drive mortgage lender fixed rates more than, say, base rate. But base rate gets much better PR coverage, and there lieth the common misconception around base rates and mortgage rates. And if this slide is particularly whet your appetite for graphs and you want to know more about swaps, let Derek and I know on the feedback forms, and we'll invite a colleague from our Treasury department to come and talk about all things swaps, because how lender funding works is actually incredibly interesting, or at least I think so. So let me know, because if you think that's interesting, we'll definitely put a session on it. This bottom graph here shows the pricing data. So the average 2-year fixed in light blue, 3 years dark blue, 5 years grey, and 10-year red. This absolutely echoes everything that Danny was just saying. So there you go. It looks like we rehearsed this bit. We actually didn't. So
can I just jump in there, Rachel? Sorry, just as a key point here. We know that the rates have gone nuts, and lenders are having to pull left, right, and centre quickly. The ask is to try and get as much notice as possible, okay? Because it's tough for brokers. We are seeing lenders still pull it within sort of a couple of hours notice or no notice at all. We have to find a way, because there is a fundamental issue. We're not talking about properly yet in this market. Brokers are getting stressed by all this because they're trying to help their customers as much as they can, and then they're finding they go place a deal and it's not there, even though they've done all the hard work to say it is. They've got to go and revisit, start the process again. That's putting pressure on them. It's going to start affecting mental well-being as a result. They are working longer, later hours. They're taking time away from the family because they're trying to do the best they can to help their customers. Okay, we're clear about that. Any ask we can do to actually make we get more communication and more notice, the better. However, brokers, folks, we also have to be cognizant of lenders here, because lenders are at capacity at the moment. They're working incredibly hard, and I'm sure Rachel will confirm that's happening within Skipton. Every time a product is pulled and they're having to reprice to try and manage flows and service, they're getting somewhere between four days worth to 2 weeks worth of business arrive in one day. Think about the staff at the lender. They're already at capacity, and then they get this lump of business turn up. They're going under pressure too, and we're all getting a bit stressed. So we've got both sides of the fence here, under pressure, all getting a bit stressed, need to manage our well-being and mental health because it's tough. We don't have the balance in the industry at the moment. So a big ask from me, let's just do our best to work with each other. If lenders could help brokers a bit more, that's great. But if brokers could be a little bit more aware of what's going on in lenders, therefore the service is going to be a bit slower because they're just trying to deal with all the cases that come in through these big influxes, then we'll get through this in one piece. So it's just a big ask for me that we just respect each other in that way, because both sides of the fence are finding it hard.
Love that. I absolutely didn't pay Danny to say that, for anyone online thinking I did. But and you can see as well, we're tight for time, so I'm not going to go into this too much, but you can really see on this slide the way the margin has eroded for lenders, and that kind of speaks to that volatility. Well, it also feeds that volatility, because we can go very quickly from making money to not in this market. Very quickly, I'm going to touch on to green slightly. So I read this article, Danny, that quotes you. Quotes you talking about green red tape, which to me just made me giggle because it's just brown tape. But for anyone who hasn't yet had the chance to read this, I've popped a link up on the slide. And just to give a bit of background, published in 2017, the government's clean growth strategy states its aspiration is that as many homes as possible are improved to an EPC band C by 2035. However, in the 5 years since, we've seen 2 further government consultations, but no additional guidance published. And although green products are far more available than they were even just a year ago on the market, I should add, and I guess caveat, this is my opinion, but the market still seems a little bit confused, wrapped up in brown tape, if you will. So Danny, why is this?
It's purely a lack of clarity. What we're hearing now is that we know as an industry, as society, we need to make changes to our lives, to our world, to our properties in order to do our best to try and help the planet out. We're all clear about that, no problem at all. But the problem is that we're being asked to do things without actually getting clarity about what we can and should do. There's still a lot of debate as to what is an EPC actually the right measure. And frankly, the more I read about it, probably not. It needs to be something that actually sort of measures more about carbon emissions. And I know the government groups, BEIS, I think they call themselves, they're looking at that. But it's all very well looking at it, but someone's got to come and give us some answers. And once we get some answers, then we can actually move forward. We're seeing green products all over the place. That's great. Do they drive an outcome? Unfortunately, a lot of them don't. And the reason they don't drive an outcome is because we don't actually know what outcome we're trying to get to. And this is where the sort of red tape comes along, is that we need to make people aware. We need to help them understand they're going to have to make changes. And yes, there's going to be a cost to it. And again, brokers are in a great place to do this. But at the moment, we don't have the clarity. We're not getting the right products. We can't give the information to the brokers for them to be as clued up and aware as they need to be in order to help their customers. And so therefore, the parts of the jigsaw are just not coming together yet. And then sit and take until we get this clarity about what it is we actually need to do, what does it need to look like, then we can structure things. And that's where the red tape is. It's just, again, we're in a situation where we can talk the talk, but we can't actually walk the walk. And that's what's really frustrating, because we need answers to be able to move forward.
Yeah, absolutely, and that really gives a good summary to that with kind of where we're all at. And again, we'll probably put stuff on that in more detail because we kind of go through the series. So Please do pop your questions for Danny in the chat bar. I've probably got time for one or two really quick ones. Let me just load up my screen to see here and see some come through. I've got one here from John. I'm seeing a lot of down valuations. Is this a sign of what's to come? What's your opinion, Danny, on house prices in the next 12 months? I think you did cover that briefly, but just...
Yeah, look, down valuations, I hear about it all the time. Yes, it sounds like there is, but again, you know, the value is just doing it based on the value that he thinks people should pay for it, and based on stats and in the local area. So again, I think the way that the house prices have been and the amount that people have been paying for it, you know, been paying well over the asking prices. So you could argue that there is going to be this period of sort of down valuation or subtle adjustment. We just need to be realistic about what the actual property is worth, and sometimes it is about what the customer will actually pay for it, and is that the right measure? So hopefully these will be minimal, but it is a topic that does come up when you have these sort of faster growing house prices, if you like, and we just need to make sure it's sensible. So I don't have the answer as to how long it will go on for, what it actually looks like. Yes, I am hearing it is happening, but hopefully it's in a minority rather than a majority, and mainly for sensible decision making more than anything else.